The Taiwanese index is in the green, up 0.4% as we speak.
Wednesday's low is 19,554, and that should not break on the way down.
Jio and Bharti continue to see subscriber gains.
MCX has announced using the new technology platform from October 3.
We're going to open fat at the 20-day MA.
Yeah.
So building on from here is very, very important. Otherwise, from a bearish perspective, they'll be happy to see so much of green on the screen. It gives them a perfect shorting opportunity.
50 points higher on the Nifty. The sensex is up about 140 points.
There are specific pockets you need to find where there is a reasonable earnings momentum.
Yatra Online is the new listing.
You can look at the past performance as an indicator of future growth.
The Indian markets are largely flat.
So they've continued to maintain their buy rating. Target price has been raised to 3,600 rupees.
43 out of 50 Nifty stocks, they are in the red currently.
Well, that was the day so far, but we begin this edition of Closing Bell on a somber note. The doyen of India's paint industry, one of the co-founders of Asian Paints, Ashwin Dani, passed away. He was 79 years old. Under his leadership, Asian Paints expanded its operations across the globe, solidifying its place as one of the world's leading paint companies. That's, of course, tragic news coming in. And gone at just 79 years old. So, that's the brief profile. So I think this is a big loss coming through for India Inc. At this point in time. So I just wanted to mention that before we go any further. Well, the market is not doing all that sort of well either. It's not been doing well from the morning. And we're down 170 odd points or so. We're down about 0.9% as things stand right now, which is pretty much at the day's lowest point. I'm Prashant. Rima is with us. Surabhi will be with us in just a bit. And Nigel, of course, is joining in as well. Guys, hi, good afternoon. So just a couple of things before we go any further. You've got two or three things, right? I mean, first is, they're very obvious. Nifty is now below yesterday's lowest point. That is point number one. It's important to highlight that because after making that low of about 19,554, we got a strong bounce, almost a 200-point bounce, and it looked like maybe the market is putting some of this behind us, but that's not the case. So we are below it. The close will be important. The 19,600 level. Is there enough in the engine to engineer that bounce in the next 60 minutes or so? That's also an important technical level, 19,605 to be precise. We see this in the morning. Bank Nifty is, of course, the weaker of the two indices, has been for the last couple of days. And there we are below, the last resistance, 61.8 actually is the big one, but 78% retracement to the August to September highs is 44,376. And we're about 10, 15 points under that level as well. And, the reasons are pretty much similar. You've got oil, you've got yields, you've got the US dollar. Nothing to do with what's happening here in India. I mean, this is all global stuff. And, those have been moving in the wrong direction. All three have been rising in conjunction, and we want them lower. So far, we've not had that. Rima.
And add to that, the September expiry, too. That could be a factor. But it's a broad-based selling pressure. There's literally no place to hide. In fact, today, banks are not performing as badly as the rest of the market. So the Nifty banking index is down close to about 0.5%, but it's not underperforming. IT has given up completely. Like the Nifty IT index is down close to about 2%. The FMCG names are under pressure. And the Nifty, if you pull up that intraday chart, it opened up with strength. It opened at that 20-day moving average of 17,760, thereabout. And from there, the Nifty just reversed completely. And now, again, it's back to the day's low. So it's about a near, actually more than 200-point fall from the day's high. We've been highlighting how the Indian markets have been the big outperformer vis-a-vis the global market context. And that, table will once again come up for you on your screen. Month to date, India is up 1.5% at a time when the rest of the global markets, whether in Asia, whether in the US or in the European region, are down anywhere between, 2 going up to a 13 double-digit fall for the Hang Seng. So some of that outperformance is getting reversed today.
Oh, yes, absolutely. And since Prashant mentioned the yield, just want to mention that it's not come off at all. 4.6, almost 4.64 now on the US 10-year. And neither has oil cooled off throughout the last couple of hours that we've been trading. So both of these cues continue to be as negative as ever. That's the dollar index. So crude itself, 96.73. So almost, very much around that 97 mark that we saw in the morning. Not too much of a cool off. And some of that's playing out in the broader market here. So look at a stock like Berger Paints. I mean, Asian on the large cap screens, of course, and even some of the mid cap names over here, where crude is obviously a huge, input. Big fall on some of these stocks. There's HPCL, BPCL, IOC, all the OMCs that are also under pressure now. So that's how it's played out. On the Nifty per se, some stories are still intact. Some is the operative word over there. L&T, for instance, UBS's call on the stock, it's worked quite well. So 2% holding on to that gain right now. And I mentioned crude. So, I mean, there are a lot of people who lose, a lot of companies which are losing because of this 97 on the screen. Some are gaining. ONGC is one of them. So there's some green over there. But Nigel, beyond L&T and ONGC, really, Nifty is weak. And mid-caps also, kind of on the edge.
Well, that's right, Surbhi. For me, the concerning factor is the breadth of the market, the advanced decline ratio. The last couple of days as well, you had the broader markets that were outperforming. Today, you have the mid-cap index that's underperforming. And those crisscross lines actually will tell you the picture, because there were far more stocks that were advancing in comparison to the number of stocks that were declining. At around 1 p.m. odd, they crisscrossed, and now you have way more number of stocks that are declining than advancing, and that's what hurts portfolios. Because we did see a bit of a consolidation, we did see a bit of a down day as well earlier this week. But at that point of time as well, the mid and the small caps were outperforming. So today would be hurting some portfolios. But we have another 60 minutes, and that's when we pull the curtains down on this series, which has actually been a positive one. We're still up more than 1%, even after seeing a correction of around 600 points from the top. How do you position yourself in the final hour of trade, though? Mitesh Thakkar joins us to help us out with exactly that. Mitesh, your reading, as well as give us the strategies.
Good afternoon. So I think, we are back to this 19,550 zone, and now it's showing real threat of breaking below that. So then I think, we should now explore where the markets could possibly head next, and the two levels on the radar are 19,400, 440 zone, and then the 19,200, 220 zone, which is where the last time index is bottomed out. The structure has become weak with the strong candles on the hourly chart, which have been negative candles, which means that the open of the hours have been higher and then the closing have been lower. So I'm slightly worried, and therefore would explore more of shorting opportunities. ABFR is something which I think the stock after 4 or 5 days of sideways action is seeing continuation of the downside. So that's a sell with a stop at about 217 for targets of 200. And ABB, we've had sell calls on ABB earlier. Now it's making a fresh swing low. So sell here with the stop at about 4,200 for targets of 4,000.
Okay, stay with us, Mitesh, because we'll need your expertise, your guidance through the course of the next 60 minutes or so. So we'll keep coming back to you. So for now, it's looking down and out. But since this is all related to what's happening globally, at least a large part of it, we have someone who tracks that space closely. Global macro strategist Arnab Das is now with us on the phone line. Arnab, good to have you back on the program. It's been a while. Thank you for your time. What's first of all, do you have a view on the trioca of troubles, so as to speak, yields, the dollar index, and oil? That's one, if you have a view in terms of where they're headed, whether they're topping off, etc. And second, if they were to stay here or not correct, what's likely to happen to emerging markets, especially India?
Okay, well, thanks for having me. Listen, I think it's a challenging environment because because of the supply reduction by Russia and Saudi Arabia, in particular in OPEC, and that, of course, has created some tension in the oil market and some expectation that inflation might be higher than otherwise, at the same time that the Fed and other central banks have been signaling higher for longer. And we have much more resilience in the U.S. economy than people have expected for some time. So I think that explains why we're in this kind of tighter environment with a sell-off in yield and in risky assets and in to some degree in emerging markets. I think it's going to be quote unquote okay, in the sense that I don't think we're looking at a repeat of what happened after the invasion of Ukraine. It's much less of a shock than it was then. We're much more advanced in the tightening cycle than we were, then and during the course of 2022. We're in an environment where, we're talking about possibly one more rate hike from the Fed, and we're possibly talking about the Bank of England going on hold for an extended period. The ECB probably also going on hold, although these pressures will add to headline inflation in those regions. Core is really what matters, right? And it tends to be the case that when you have these pressures on inflation, headline inflation through energy prices or commodity prices late in the tightening phase, it tends to be inflationary for headline inflation, but it also tends to be, restrictive for consumers and others to spend. So it probably means that we're getting closer to the end of whatever kind of cycle this is, and that it'll eventually be what we are calling a bumpy landing, right? That there are a lot of issues and shocks and polycrises, as they say, going on. But it's not a systemic kind of crisis. It's not a situation where, because the Fed has been tightening so aggressively, that quote unquote something is going to break, right? What's happened is regional banks have broken, but those were interest rate losses, not credit losses. So it wasn't a consequence of the transmission of monetary tightening into a recessionary force. It was a problem in the balance sheets of those banks. And I think that's a good metaphor for where we are. We're going through this adjustment. It's bumpy, but it's not terribly painful, actually. And it's not certainly not a crisis situation. Yes, sorry.
Arnav, sorry, to come in over there, I just wanted to ask you this. What you said right now, the banking issues in the US, those were interest rate hiccups or problems, not credit problems. But could the interest rate problem at some point in time start becoming a credit issue as well? And is that perhaps something that no one's kind of anticipated right now? And the reason I ask you this is that you've got yields at 15, 16-year highs. Stock markets, the US market is barely 6% off the peak. India is barely 3.5%, 4% off its peak. So have equity markets not adequately priced in possible risks?
Well, I think that certainly is a risk, and I think it's something we all have to keep in our minds, that this could still go significantly wrong. I would say that it's a tail risk rather than a very significant, very high risk, let alone a central scenario. And the reasoning is this, right? That during the easy period when monetary policy was, when rates were zero and central banks were expanding their balance sheets because we had, quote unquote, low inflation, the reason we had very low policy rates or negative policy rates and negative yields in many cases, in many bonds, is because the private sector was not gearing up very heavily during that period, right? So we didn't have the kind of ramping up of risk in the financial sector, and especially in the real sectors of the economy at the time when policy was easy. That's why it had to be so easy, right? It's because there wasn't that much investment, that much leverage going on. There was some financial leverage for sure, but there wasn't a huge amount of capex going on. That's why we had such low yields. And that's why this tightening phase is likely to be, to unfold very differently than other tightening phases. Actually, the leveraging up took place in the public sector, not in the private sector, because the private sector was, if anything, deleveraging after the global financial crisis, after the Eurozone crisis, and even in emerging markets, right? There was a big credit boom in India and other countries in the aftermath of the global financial crisis. And of course, everybody will remember in India, we had the twin balance sheet problem. That's been substantially worked out now with a period of somewhat lower growth. And so I think, private balance sheets generally are in better condition than in most tightening phases. So that's why I don't think I think we'll have some credit losses for sure. That seems quite likely. But whether it's a really serious problem, I think that seems relatively unlikely. Now, of course, if rates have to go a lot higher and stay a lot higher for a lot longer, that risk will rise. But I think that's unlikely because we have been tightening. There is evidence the economies are slowing down in the West and core inflation is falling.
Arnab, thank you very much for joining us this afternoon here on CNBC TV 18. We need to slip into a very short break. We'll come back and talk about the Indian market stocks. Deven Choksi joins in on the other side. Welcome back. Extended the decline now. It's 19,530. It's inching towards a 200-point fall on the Nifty. The sensex is down close to about 500 points, so now it's looking a bit ugly. But we'll talk more about it. Want to get you a CNBC TV18 exclusive, where sources say Chola Investment QIP is likely to open today. Sudarshan is here with the details. Sudarshan.
The non-banking financial company of Murugappa Group, Chola Mandalam Investment Finance, has been buzzing off late. And now we hear from sources that the company is planning to launch its QIP today with a base size of Rs 2,000 crore and having upsize option. Of total Rs 4,000 crore fundraising approval that the company has from the board, Rs 2,000 crore is likely to be raised via QIP, and for another Rs 2,000 crore, company may make an allotment of compulsorily convertible debentures. Floor price for the QIP to be launched today is likely to be somewhere in the range of 1,160 to 1,180 per share, which is at a discount of 4 to 6% from the current market price. And as far as demand is concerned, sources say company has received a strong demand from the investors. In today's session, the stock has hit record high of 1,240. It has almost doubled this year. The low that saw this year in January was 658. From that level, it is up nearly 90%. CNBC TV18 has written to the company seeking its response to the QIP launch, and the reply is still awaited.
All right, Sudarshan, hang on though. MCX is well surging in trade as they are all set to go live on the new technology platform from October 3rd. Do note this development was revealed through CNBC TV18 earlier. Sudarshan is back with us to fill us in with more details. Sudarshan?
MCX will be going live on new technology platform from October 3. It's the platform for which MCX had signed agreement with TCS 2 years ago in September 2021. Now, earlier this year, MCX had renewed agreement with 63 Moons to use its platform till December, which was at a cost of Rs 125 crore per quarter, which was almost 100% of total sales of Q1 FY24. Now, if we look at the historical data, the cost for technology platform saw a major jump in last 1 year. In Q1 FY23, the cost was Rs 19.28 crore, which was just 17% of the sales. Now, come to Q4 FY23, it increased to 87.3 crore, which was 65% of total sales. Now, analysts assume once this technology platform of TCS is implemented fully and the platform of 63 Moons, agreement of 63 Moons expires in December, there will be a major cost saving for MCX. They assume that the cost of technology platform will come down to 10 to 12% of total sales from the current figure of 100% of total sales.
Thanks a lot for that, Sudarshan. Well, Devin Choksi is with us. Devin, I wanted your view on both these two stocks, either one or both of them. MCX, the stock is surging away. They're going to be moving finally to the new technology, as well as Chola Finance Investment.
Hi, Nigel. Good afternoon. Well, I think MCX particularly for sure, I think the advantage is that on one side with the new platform coming in, the cost that they have been paying for the existing platform which they were having, which I would call it as a legacy platform, I think they are going to be significantly saving on that particular cost. And in my viewport, I think the direct reflection of that particular cost saving due to adoption of new platform could be seen in the profit and loss account of the company from the very first year itself. Should that be the scenario that we are looking at, I would think that market has already justified in giving a de-rating to the stock from what it was to what it is now at current levels. Not considering other aspects of how the exchange would probably perform hereafter and all, I would think that this in itself, cost saving itself, is a big achievement, as I would call it, for the exchange. Let's see how exactly the balance sheet numbers look like, but remain distinctly bullish about the possibilities of better numbers hereafter.
Devin, afternoon. Would you now be worried about the impact of crude prices on companies and the balance sheet, on the margins? Is it time to start factoring in, this particular factor when you make a portfolio choice?
So, good afternoon, Riva. On one side, you have got the rising crude oil prices, which is not a good sign for the global economy in general and India in particular. On the other side, Indian companies, the crude oil processing companies, refining companies included, I think are not going to take the full advantage of this particular situation because of the 15-day revision in the price formula under the windfall tax. Given the fact that on 15th of September, just a fortnight back, the price has been increased to 10,000 per ton from 7,000 odd levels. I think so. Obviously, I think with the rising crude oil prices, I think further increase in the windfall tax could happen, and that will take away whatever the benefit that these companies would otherwise make. So, not very particularly excited about, I think, the rise in the crude oil prices and the prospects therein for many of the companies. At the same time, those who are in exports, I think they tend to get taxed only when I think the differential rate goes about $20 to a barrel, which is processing charges on the refining charges, as we call it as. So there again, I think it's a slightly better situation, particularly for likes of Reliance. But I think the overhang continues. So we would probably stay away from it, I think, for the time being, because of this uncertainty about the crude oil prices in the coming quarter.
Devin, again, not oil, but commodities, Vedanta, any thoughts with all that's been happening? Yesterday, it saw a very large cut, but your thoughts?
So yes, Prashant, I think having seen that they have already pledged their majority of the holdings, I think both in Hindustan Zinc as well as in Vedanta Limited, by the promoters for the purpose of giving security collateral to the lenders or creditors of Vedanta Resources, their parent companies. The next best thing that possibly could happen would be to sell some of the assets, I think, which they have. And as we hear, I think some of the mining assets in Goa could be on the blocks as far as generating the cash flow is concerned. I do not know how exactly it will benefit, because in the following 2 years' time, as we gather the data, the amount of money which is required to be paid back, I think is going to be quite significant. I think more than $3.5 billion, I think, is the amount of bill or the money that is required to be paid. Now, in that kind of a situation, I would, for one, think about this company, basically, I think, take this particular situation to their advantage and make some strategic investor as a partner into the business. That could possibly, I think, make more sense, because I think even if you sell some part of the assets and generate cash, you may probably mitigate a situation for the time being. But I think the growth, if it is required to be taken up by the business of the company, then in such situation, capital requirement would be higher, and that is where financial investor would be more meaningful entry at this juncture. But this is my view. I guess I think till that point of time, market will continue to face this overhang, and the stock price is expected to suffer, unfortunately.
Devin, thank you very much for joining in. Shibani Sarkar Kurian, Senior EVP and Head of Equity Research at Kotak Mahindra AMC, is with us on the show now. Shibani, afternoon. India's outperformance resilience is getting tested in today's fall. So we've seen quite a decline in the Indian equity markets, and it's broad-based selling. There's literally no space sector theme which has been spared. Do you think markets are in for a bit of a correction? We could, see a little more of a decline from here on, considering our outperformance? We could align ourselves with global markets?
Hi, good afternoon, and thank you for having me on the show. So if you look at Indian markets into two parts, one, if you look at from a fundamental basis, our growth, both in terms of macro as well as earnings, continues to remain fairly stable and robust. And corporate earnings profile has been holding up for a fairly long period of time. And that has been one of the drivers for markets, apart from flows. But however, the other second aspect of markets, which we've been highlighting for a while, is the valuation aspect. Our markets have clearly been one of the best performing markets, and that outperformance has meant that India on a relative basis is trading at premium valuations, which are above long-term averages. If you just look at absolute valuations as well, Nifty is now trading above its long-term average multiples on a price to earnings basis. So whether you look at it on price to book, yield gap, any of these parameters, valuations are looking somewhat stretched. Now, within the market construct, if you look at large cap, mid cap, and small cap, our belief is at this point in time, mid and small cap valuations are appearing stretched on a relative basis, specifically to the large caps. So therefore, if you look at the mid cap valuation premium on a 1 year forward price to earnings vis-a-vis the Nifty, for instance, that number is significantly above its 10-year average multiples. And similarly, the small cap premium or discount to in terms of price to earnings to the Nifty has also narrowed considerably. So therefore, from an absolute basis as well as on a relative basis, we do believe that valuations, especially in the near term, especially where mid and small caps are concerned, are looking somewhat stretched vis-a-vis large caps. And therefore, we believe that at this point in time, given the kind of volatility that could be expected in the near term, large caps are better placed in the market.
Right. You're absolutely right. You guys at Kotak were, you sounded out the caution on broader markets, I think the first, you and others that we've been speaking with from the Kotak platform. But I think a lot of the sell side has now followed suit. I think that Kotak institutional equities, not on the other side, they came out with a report, I think, which was widely read. And more and more we are hearing that kind of
cap dash. You remember?
Less uncharitable.
But that's what they called it.
Okay, but Shivani, so then look at large caps, right? That's the whole point, and where things are a little more reasonable. But let's just talk about banks, for example, right? And I think when we talk banks, I think it all comes back to HDFC Bank and what's happening and what's likely to happen, etc. But what about names like IndusInd Bank, etc.? You think it makes sense to kind of look at banks down the curve, which have consolidated for a long period of time, have not done very much. Business momentum generally seems to be pretty strong.
Yeah, Prashant. So when you look at the banking sector and what's really happened, say if you look at calendar year to date, we will clearly see two parts of the sector. So one is the larger private banks, which have not participated in the market movement at all, while you have the public sector banking space and some of the old generation private sector banks and even some of the NBFCs, which have clearly participated in the overall market up move. Now, where the banking sector is concerned, and specifically some of the larger private banks, the two key concerns which are there at this point in time, one, that loan growth will slow down, and second is the trajectory on margins. Now, if you look at data on loan growth has actually been holding up much better than what was anticipated at a system level. And some of the larger private banks will possibly grow ahead of a system, and therefore that market share shift in terms of loan growth would continue. Now, margins have clearly peaked out, and they possibly peaked out in the fourth quarter of last financial year. And therefore, there will be some pressure on margins going ahead over the next few quarters. However, if you look at from an earnings perspective, banks have a lot of cushion, especially where credit costs are concerned, and maybe to some extent in a few cases where operating expenses are also concerned. And therefore, the earnings impact because of margins coming off is not likely to be significant. And therefore, what we really believe is if you look at the larger private banking pack, where we have seen significant ROE expansion over the last couple of years, multiples are looking fairly attractive. And therefore, within the large cap bucket that you were talking about, this is one sector or segment which looks attractive, both from fundamental as well as valuation perspective.
Okay, all right. Shivani, just hold that thought. As we speak, the markets actually are taking a swing down for the worse, actually, because we have ITC that's moved to the low point of the day. NTPC as well has seen some bit of selling pressure, and Grasim. Just pull up the intraday chart of some of these stocks. Some of this fall could actually be expiry related, but the bears clearly are on top as we speak. And in the final hour, if you're hoping for a short covering, well, that's a hope at least as of now, because it appears the selling pressure is intensifying and the stop losses actually are getting triggered, the 19,550 odd mark. Well, Shubhani, you spoke about the banking sector earnings. Do you think the markets have taken for granted that we'll see 15% earnings for the next couple of years for the Nifty EPS itself? And that actually could be at risk, given the crude oil prices have spiked up and some slowdown as well we're seeing globally.
Yeah, you're right. Absolutely, Nigel. That I think for the markets at this point in time, if you look at valuations are clearly factoring in fairly strong earnings growth, which is in the mid to high teens for FY24 and FY25. As of now, till the last quarter, earnings has been holding up fairly well, and there has not been any earnings disappointment. From a demand perspective, and if you look at the overall construct of earnings are likely to be now driven more by margins rather than the top line growth. And therefore, that's what we've seen in the last few quarters, where margins have been now the driver for earnings for corporate India. And in that context, if there is a sustained increase, for instance, in terms of crude oil prices, or if input cost pressures start to factor in, then therefore we would have to then revisit earnings. So going into this earnings season, which is going to come up, which is the second quarter numbers, a few key factors that we will watch out for. One is in terms of the top line or in terms of demand environment. The bottom of the pyramid, rural demand recovery, that is something that we will have to keep a close watch on, whether that comes through, especially during the festive season, and what's management commentary. And secondly, the outlook on margins. So yes, as of now, I think one risk that we would have to keep a close watch on would be the trajectory of earnings. Having said that, I think corporate earnings or corporate India in terms of both balance sheet, cash flows, as well as return ratios seem to be very well placed, because over the last few years, we've seen return on equity as well as cash flows improving for corporate India, and leverage has gone down. So from that perspective, corporate balance sheets are fairly strong.
Shibani, out of time. Thank you very much for joining in and providing that insight on the market. We'll slip into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also tell you what you can buy today to sell tomorrow. Calls from our experts.
Welcome back. At least for now, the Nifty has managed to defend the 19,500 odd mark, but we still have more than 25 minutes to go. So just keep an eye out on the screen. If the session goes to the bulls, though for the series, we're still up close to around 1%. And just one stock, SJV, and I think we should get the intraday chart of that one. That's suddenly seen a big move, and volumes as well are pretty high on that one. So SJVN is a stock that you should keep on your radar. But it's that time of the day where we get you an insight into D Street Chatter. Nimish is with us. Nimish, tell us, what are you picking up and how are you reading today's session?
Hi, Nigel. The screen is looking bad for sure, but that doesn't mean that the flows are equally bad. So that's the feedback that yes, there are negative flows, but it's not that bad for a Nifty to fall 1% and the broader markets to fall more than 1%. Now, there are a couple of reasons why we are falling in today's trade. One, of course, the weak global cues, crude, dollar index, the 10-year yield, all showing negative signs, and that's negative for emerging markets. So that's one of the reasons. But also, there are technical factors. One, of course, because of the September expiry, that's adding to some pressure. And also, there is this, quarterly closure as well. So a lot of, larger HNI seems to close the books on the quarterly end. So I think even that's adding some bit of pressure. And also remember, Monday is a holiday for us. So kind of a truncated week next week as well. So I guess that's all putting pressure on the broader markets as well. And that explains more than 1% cut in the Nifty mid-cap index, more than 1% cut in the small cap indices as well. But broadly, the feedback is, as I said, the screen is looking bad, but the flows are not that bad is what I understand. Also, today's number may not be good to read also because of the adjustments, the expiry adjustments. There is a Nifty rebalancing as well. So that flows will also add up. So the numbers may not be a right picture to look at, but broadly from a sentiment point of view, I guess from a technical point of view as well, the 19,600 was a crucial level. We've broken that. So need to see in the next half an hour how are we able to defend that. But from a trend, I think we've broken the trend on the downside. But flows are not very large. On the negative side is the overall feedback.
Yeah, and Nimish, sometimes on expiry day, those weak hands, they get cut on the wrong side. Because today everyone would have thought, yesterday we bounced from 19,500, maybe take a bit of a punt. Now those weak hands will be in trouble.
First half we bounced back, right, from our opening. So I guess that also was the reason for the weaker hands to get exited in this negative pullback.
All right, what about individual stocks?
Well, there are a lot of names which are on my list. I'll start with the first two stocks where there were large blocks and big reaction to those names. So the first one is Quick Heal. That stock is up 16% last when I checked. 3.5% equity got changed hands, and I believe the private equity investor was a seller in today's block. Need to see who are the buyers there, but in terms of seller, looks like the PE was a seller there. So that's the first one. The second from that list was HOEC. Even that stock is locked at 10% upper circuit after a large block. Nearly 2% equity got changed hands there, and I believe one of the strategic investor in HOEC was a seller. There is no promoter holding there. It's largely owned by institutions, but there is a strategic investor holding close to 6%. So they were the large sellers in today's block. So that's the second one. The third, again, part of the block deal was Happiest Minds. Even there was a large block, nearly 1% equity got changed hands. I believe the promoter entity was a seller in today's block. So even there, the disclosures in terms of buyers could be quite interesting to track. And the last is a couple of private bank names. Even yesterday, the feedback was some small buying interest is back. To just extend that, both Bandhan Bank and RBL Bank end up marginally under pressure today. But the overall feedback is large part of the selling from the FI seems to be largely over, both in Bandhan Bank as well as in RBL Bank.
Nimish, anything you're hearing on that Chola story which Sudarshan put out?
Well, it looks like it's a done deal. The whole deal got delayed just because of the CCD approval. I believe that approval came last evening, and hence there is a very high possibility that the book will get launched today evening. The demand is quite strong. It's a small, for the size of Chola, it's a small QIP, just 2,000 crores. But I understand the demand is quite strong. So there won't be a large discount in the QIP is the overall feedback, and it's well bid by some long-only fund. So should go through, and there is a CCD as well of close to 2,000 crores in that fundraising plan.
Okay. No question of a cut or anything. I mean, it's just been done phenomenally, and there is. Can't imagine why there would be a need for a big discount or anything, as Nimish pointed out. Nimish, thanks very much. Interesting list. Quick Heal, HOEC, Happiest Minds, Bandhan and RBL are on Nimish's list today. Mitesh is joining in with what to buy or sell today for a reverse trade tomorrow. Mitesh, first a quick word on the market, which is now down a full 200 points. And then tell us your trades.
Prashant, I think, breaking below 19,550 is slightly negative is the way I read it. And this would set us up, for a retest of possibly, with some volatility heading back towards 19,200, that possibly become very strong. So explore more of shorting positions. I have BTST or STBT rather on Wipro. with a stop at about 407.5 and a target of around 398. And Z is the other one, which is also breaking down. So that's an STVT with a stop at about levels of 257.5 for targets of 248.
Okay, Mitesh is sensing a possible breakdown in the market, and the Nifty could head to levels of 19,200 because that crucial support of 19,550 has been breached. Well, today we also had a new listing. Well, it's not a great day to have a listing, but the company is Yatra Online Services. As the name says, and this is a brand we're all familiar with, it provides online booking, air ticketing, train booking, hotels booking, very similar to Easy Trip and Make My Trip. They had a weak debut on the exchanges. In fact, the opening take was a 10% discount to the issue price. Now it's settling with about a 4.5% fall. The way Yatra is differentiated from other players like Make My Trip or Easy Trip is Yatra has a greater percentage of its revenues coming in from corporate bookings. We had a chat with Dhruv Shringi about the way forward, the growth plans, acquisitions, etc. Listen in to what they had to say.
We are the largest player on the corporate travel side of things, and we've got about 800 plus large marquee corporate customers that we service, and this has been growing at a very healthy rate. If you were to look at pre-COVID, we were growing at almost 2x of the market rate. So we expect future growth to continue to be strong, and in terms of market, we expect the market to grow at between the 10 to 12% mark, and with us guys growing significantly faster than that. So in terms of market share, that will translate close to about a market share of about 6% in terms of customers. But if I was to look at that on a volume basis, because we are serving the top end of the market, it would translate into closer to about 9% of the overall market. So on the acquisition front, we've kept some firepower aside to do some M&A on the corporate travel side especially. We've done such acquisitions in the past that we've successfully integrated onto our platform, and we would expect to look at doing something similar in the near term as well. We are also looking at other ancillary services that can bolt onto our platform and be sold to our large corporate customer base. These are things which are work in progress. Acquisitions, as you're all familiar, do take time. So I can't really define a concrete timeline something, but all I would say is please keep a close eye on us and you'll see exciting stuff happening in the near future. In terms of margin profile, if you look at the blended averages, we are looking at about 11% kind of blended operating margin at the EBITDA level. And if you were to look at this from a individual business perspective, the margins typically on the corporate side will be around 2.5 times higher than what you would see on the B2C side. We would target about 60% of our revenue coming from air, about 30-35% coming from hotels and packages, and the remaining coming from other services. In terms of margins, while we are currently at about 11% kind of margins at the adjusted EBITDA level, we would expect the adjusted EBITDA margins to get closer to the high teens, if not get to the 20% threshold over the next let's say 3 to 5 year horizon.
That's Yatra for you. Amrish Baliga, independent market expert, is with us on the show. Amrish, you've been tracking the entire hospitality space, whether it's travel, Indigo is a stock that you've spoken about. We've spoken about hotel companies. Have you looked at Yatra Online, and how would you compare it with the other listed entity, Easy Trip, and which one would you pick and why?
Yatra, in case we see a further correction, because anyway it was, I think, richly priced. So, I see a further correction in this. And we really cannot compare Yatra with others because it is more of a corporate sort of clients, like they rightly mentioned. And we should remember that in corporate, you get those volumes, but you don't get those margins. So I don't see a huge margin expansion. So I would possibly prefer for a slightly lower level to get into Yatra, again, from a longer term perspective. So if we see a correction of about 15-18%, again, based on the valuation and also based on the way the markets are going, because we should see a decent correction since it's broken important technical levels. I think we should see a decent correction in the market. So that is the time possibly to buy Yatra at lower levels.
Okay, all right. Hi, Amrish. Amrish, Q3 is normally a strong quarter for hotels, aviation stocks as well. And this time around, you have the additional kicker because the World Cup as well is on the cards. I was looking at a report from Jefferies, and they're saying that the hotel rates have gone up multiple times, nearly 4 times. And if you're going for the India-Pakistan game, it's nearly around 13 to 15 times, depending on the hotel. But I believe you have a hotel on your radar. Which one is it?
Yeah, it's Indian Hotels, again, the best known India's luxury hotel brand, Taj, as well as they have others like Selection, Vivanta and Ginger. So totally they have about 33,000 keys, across 270 properties, which also include properties in the pipeline. Recently, they opened one at Vikhroli in Mumbai. 4 days back, they inaugurated a resort in Sikkim. Others in pipeline are Frankfurt, Ayodhya, Dhaka, Raichak in West Bengal. This should happen in the next few months. And in fact, we are looking at about 20 hotels to be opened before the end of this financial year, FY24. So in FY25, we should see Taj actually crossing about 300 hotels overall. And they've been following a asset-light strategy. So 50% of the hotels are under management contract. And if you look at the average room rents, like you rightly said, the way the room rents have gone up, they're at lifetime highs. And the best part is it is sustaining, because earlier also we have seen room rents going up like temporarily, but they were not sustaining. But now we are seeing these higher levels sustaining. And if you look at the occupancy levels, they are like about 70% plus, which is decently good. Domestic EBITDA margins is about 34%, but if you look at the blended margins, including international operations, about 30%, which is again decent, and should increase to about 33% by FY25. And if you look at the balance sheet, virtually debt-free at the net level. Net debt to EBITDA is about 0.5. And we have seen that the new lines of businesses also have started contributing, like the food delivery, which is Cumin, Taj Chambers Club, Homestay Bungalows, which is Ama Stays and Trails. See, all these have, again, started contributing. Although it's small, but that's growing. So going ahead, I'm looking at a revenue CAGR of about 15% and an EBITDA CAGR of about 20%. So expecting an EPS of about 10 for FY25. And here my price target now is 480, which is a decent 20% from here. But I would suggest, looking at the way the markets are, one should buy in tranches and not the whole thing in one shot.
Today, CARE has upgraded the rating on Indian hotels. The outlook stays at stable, but the rating has been upgraded by CARE.
Okay, well, we'll take a quick commercial break here. There's about 10 minutes to go for close. And we're down 180 points. 19,535, 536 is where we find ourselves at. We'll take a quick break. Ambrish is still with us. We'll come back with more on the other side. Stay tuned. Welcome back. 175 points lower. We are at 19,540. Ambrish is still with us. So no real recovery or anything of that sort. Market breadth is negative. On my screen, if you look at the overall NSE stocks, 830 stocks are higher, and you got about 1,450 stocks which are lower. So clearly in favor of what's down right now. Tech Mahindra is the big loser. I mean, I think it's down about 4.5% or so. So that's taking a bit of a cut. LTI Mindtree is down about 3%. I'm looking at large caps here. Wipro is down about 2.5%. And there is Infi, which is down about 2% or so as well. So this is broadly, what's happening there. Amrish, any thoughts on names like Techem? Large cap IT, actually. We had, Sandeep, who was with Novama, Edelweiss, etc. earlier, tracks the IT space closely on this space. And he doesn't believe that, one necessarily, it's a bearish kind of scenario here.
Absolutely.
What's your own sense?
I mean, I also believe so, at least for the next 1 or 2 quarters, because I think we'll see a revival. I mean, the earliest revival possibly could be in the December quarter, if not possibly the March quarter. So once we see the numbers for Q2, I think we could again see correction in the IT space. So this may not be the right time to buy into IT, possibly wait for another quarter or 2 more.
Okay, all right. Amrish, just hold on to that thought. As we speak, the markets have actually bounced 50 points from the low point of the day. 2 factors could be playing out. One is expiry related. So that's why we're seeing by the end some bit of a bounce. Though keep in mind, for more than 15 minutes, we are closer to around 19,500. So the averaging will be closer to that mark. So that's one point. The second factor is that semi-annual, a reshuffle, a rejig or rebalance that's taking place. So that's why you have stocks like Power Grid that are reacting favorably. That's moved to the high point of the day. So some of these public sector banks, public PSUs in particular, beg your pardon, that's the one, in fact, that's moved up as well. And another couple of names, heavier names that are doing well. You have Bharti Airtel. Just pull up the intraday chart. It appears this one as well is on its way to around the 1,000 rupee odd mark. Pull up the intraday chart. Bharti Airtel is the stock that we're talking about. Amrish, I wanted your view on 2 stocks that were big casualties this week. One is Vedanta, the second one is Delta. Now, both of them have their set of problems, but sometimes these problems become buying opportunities. Would you buy either of them?
I would surely buy Delta because I think, the figure which has come out, the GST figure is obnoxious. And this has been across, all the players in that space. And I don't see that demand attainable in the, at least in the eyes of, the courts. So I think finally, this will go off. It could take a bit of time. It could take possibly the next 12 months to 15 months. And that is the time you could see pressure on these stocks continuing. But having corrected so much, I don't see much of a downside. So in case, one has the patience for the next possibly 18 months or so, I think Delta is a good buying opportunity at this point of time. When we talk of Vedanta, all through we have seen that, the dividends have been good, no doubt, but then the management has never been investor friendly as such. Basically, they have seen it only from their point of view. And what we have seen in the last couple of years, the high dividends were basically the cash flows which the promoters or the promoting entities required. And now looking at the way the balance sheet is and the sort of issues they are facing, I don't think one should even look at buying Vedanta even at these levels.
Okay. All right. We'll leave it there, Amrish. Great speaking with you as always. Thanks very much for your time and speak again soon. We got a bit of a bounce, as Nigel pointed out, from the lows of the day. But is that enough? I think, it's a bounce. Could have been worse, but the point is we will end below yesterday's or round about yesterday's lowest point. Yesterday's low was 19,554. We're at 19,554 now with a couple of minutes to go for close. But that bounce completely, no follow through to yesterday's bounce. So in that sense, it is a bit disappointing. The Nifty Bank will come up on your screen, 0.75% lower, and that's a steady downward kind of move. In percentage terms, on a day-on-day basis, that is just today, Bank Nifty lost less than as compared to the Nifty, but no real bounce or anything. It was down and out for a bulk of the day. Mid-cap index will come up on your screen, 1.25% cut there, and I think you've got the small-cap index which will come up, which has done much better. So actually the winner has been that one. Is down, but just 1/3% lower on the Nifty small cap index. IT was, I was pointing out the large cap IT names which were the big losers, even mid caps. Names like Happiest Minds and, Emphasis, etc. Lots of cuts there from that space. That's one large pack, large weighted space, both in mid caps and large caps, which came under selling pressure. Rima.
In fact, the top nifty loser is an IT name. That's Tech Mahindra. It's also been the best performing IT stock year to date with a 21% rally. And today you saw profit booking there. Other losers include a Wipro that also ended under pressure, and LTI Mindtree. Asian Paints buckled under the weight of rising crude prices. So Asian Paints was down close to about 3.7%. In terms of the banking names, Kotak Mahindra Bank, IndusInd Bank end with cuts of close to about 1.5–2%. HDFC Bank ends in the red, but the cut is not as deep. So HDFC Bank is down close to about 0.5%. FMCG, along with IT, FMCG took the brunt of selling pressure today. So Britannia, ITC, HUL. These are stocks with cuts of 1.5–2%. On the gaining side, not much to report. It's L&T which stands out, top nifty gainer. UBS today has raised the target price to 3,600. So significant upside. Bharti Airtel, where the company has been gaining subscriber market share at the expense of Vodafone Idea. Bharti Airtel saw buying particularly in the last 1 hour of trade. And Power Grid, last 30 minutes pop, pushed the stock to close in the green. All in all, the bell is gone. The Nifty is going to close at 19,550. Not at the session lows, but with a cut of 165 points, 0.8% lower on the benchmark.
Remember, a lot of these new listings did well today, actually, if you can pull these names up. RR Kabil was up strongly, 5–6% mover. It's a few days old, by the way, in the markets. There was, that's RR Kabil, look at that, 6%. Zaggle was up sharply. It's been doing well. Day one listing was, I think, a little subdued, but after that, it's been consistently doing well. That is Zaggle. There you go, 195 now. EMS Limited, which is again, which came to the market recently, about 6–7 days old, that was higher. And not so recent listing, which is Dream Folks, that was up sharply as well. So, a much smaller list of gainers today as compared to losers, but you had some of these recent listings doing well. So that's the market down and out, but we'll of course watch what US does later for more cues, at least in the very near term when we come back tomorrow morning. Well, as we wrap up this edition of Closing Bell, here's some footage of Ashwin Dani from the India Business Leadership Awards 2022, the visionary co-founder of Asian Paints No More.